Okay, so I think we better get straight on. So good morning. So I'm Tony Hadley, here to give you a rapid overview of kind of some of the dynamics of what's happening in our industry. And I think we're in one of the most fascinating times ever of change, potential for change, opportunity for change. So we see there are amazing Chinese plant I've had the pleasure to visit a couple of times. So let's get going. So an important thing, I'm going to talk about lots of things, and the idea is for you to think about how this can affect your business as a risk or as an opportunity. We are seeing lots of different directions. I think we're seeing a fragmentation of the industry, a restructuring. We just saw it in Arno's concluding slide there. So just use this as food for thought, and I'm not going to go into the detail of every slide. So I called it musical chairs precisely because things are turning around, everybody has to sit on a chair, and suddenly someone's left without a chair to sit on. So, and there's different chairs, different sizes, different size fits all. What we've also seen is, because I'm a consultant on one side, I'm an investor on other sides, partially in cement, partially in other things. So I always take an investment point of view, because ultimately we all have to make money to keep the machines working and to keep growing and developing. And what we've seen is an amazing improvement in profitability in the majors. Let's focus on the Western majors first for a little while. Massive increases in profitability. And also, we've seen a return to cement as an investable sector. We were hated 10 years ago. No one wanted to buy cement companies, terrified of the carbon issue, and we were just almost untouchable. So we've seen big changes, and the companies have adapted to evolve to those changes. Oops. And here, very interesting chart. This is EU on the evolution of cement prices over the last 25 years and the evolution of costs. And what we've seen is this sudden breakout of profitability, and a lot of that has been driven by price. And if you look at, I'm not sure it's working. If you look at the chart on the right there, that shows how the prices suddenly increased post-COVID. They've stayed up there, and the gap has been widening through great discipline and companies no longer chasing volume. We were always volume, grab market share, and that attacked margins all the time. So now we've moved to this phase of discipline, much more discipline, accept some volume reduction, make more money. And I think that's been a trend basically since COVID, and in many of the developed markets in the world, that is what is driving this profitability. And if we just look at three of the majors in the Western world, they're not in the emerging markets, some of them are. CRH has been outstanding. If you look at the total shareholder return, TSR, in the last, 55 years of CRH, from nothing, they've managed to produce 16% per year over 55 years. Absolutely phenomenal. Part of that is driven by the EBITDA multiples, EV over EBITDA, increasing, but the business has grown amazingly. They have set hugely aggressive targets for 2030 in their Capital Markets Day. So they're promising a lot from America, and because 80% of their business is USA. They're very focused, and they're much broader than just being a heavy building material, and they've been very successful, huge M&A pipeline of very small deals. Oops. So we've presented Holcim and Amrise together here. Both companies, as you're aware, they split. Amrise listed in the US, focused on USA and Canada, or exclusively there, and Holcim. What is interesting is Holcim is actually being seen very well and is trading at a higher multiple than Amrise, because no one's quite sure about Amrise and whether it can promise on its very big promises for the USA. And Holcim, we've seen rotating their portfolio, divesting. Africa's my speciality, so they've been running away from Africa. They sold things super cheaply, and they've been running into South America, buying South American assets, at the same time of Cemex, who you think Cemex, they know South America, Latin America better than anyone else. They're selling, and they want to put money into the US, $6 billion allocated to the US. So someone's got it right, someone's got it wrong. We will learn who, but certainly a lot of focus. I think the big question for Holcim is, what are they going to do with Huaxin? They own 42% of Huaxin. I feel it will be an exit. I may be wrong, but it kind of would make sense. Then we look at Heidelberg, and they have positioned themselves as the global major in heavy building materials. They're saying, hey, we stick to what we've always been doing. We focus the portfolio. And again, I think for the majors, the key words are focus and discipline. They've always been ill-disciplined, suddenly doing massive acquisitions and destroying a lot of value, and they've been trying to be everywhere. There's much more focus. So even Heidelberg, who are very keen and want to remain in emerging markets, are being disciplined, divesting small positions and building on the assets they have. They also love America, and so the big question for me of what's happening here, everybody loves America for some reason. I think they're crazy, but everybody loves America. The price you need to pay to acquire cement business in the US is what, 25% or more premium on anywhere else, sometimes more. Is that all going to fall apart because everybody's rushing for the same targets? So I think very interesting times for the majors. CCS we'll touch on in a minute, but these companies, Heidelberg's going to have 10 billion euros or dollars, I forget, of free cash flow to spend. So they have to keep buying companies. So it's going to be very, very interesting, the future, and that M&A activity is going to be busy, probably not huge deals, probably targeted. So, carbon capture. For those of you who know me, I've been negative on carbon capture for a very, very long time. I think it is, I'm waiting for our Chinese friends to come with a really cost-effective, structured solution. Because otherwise, carbon capture is crazy. And we saw Holcim in Belgium say they're not moving forward because it is suicide. That was the word of their management. Suicide to do carbon capture. Because carbon capture, at the moment, certainly in Europe or US, is suicide if it's not fully funded by government. And who is government? You, taxpayers. So I think we're really going to see a slowdown. You saw the comment from Goldman Sachs saying that the EU's 30 billion fund could help profitability. You cannot make money in carbon capture unless it's fully funded or almost fully funded by the state, by the taxpayers. And people can't afford that anymore. So I think it's very, very interesting. Finally, carbon capture may come, but in 35 or 40 or 45, when someone has found a way to do it cost effectively. And what we see is that there are so many opportunities just improving your existing business. Every time my company goes and visits a cement plant, we find literally millions of dollars left on the table because people are not analyzing honestly their performance. So I think there's plenty to do on decarbonization just by doing things better. We'll look at that in a minute. And as we've heard, SCMs, and probably the most interesting one at the moment, is calcined clay. Calcined clay started slowly. We started looking at it very carefully in 2019 and realized that this is going to take off because calcined clay brings you reduced CO2 and it reduces your cost. We saw it earlier in this morning's presentation that the beauty of calcined clay is it reduces your cost. And for those of you in markets where you need to keep increasing capacity, it's very cheap additional capacity for your plants. So I think we're going to see a lot of on calcined clay and in general on SCMs. That is the roadmap for the next 10 or 15 years in my view. So on the majors, it's always been a hugely cyclic industry. Great profits, big vision, big egos, buy, disaster, rebuild. And I think we're really starting to see some change in that, as I've highlighted, repositioning of the models, repositioning of priorities, and very much stronger priorities. But we're also seeing some big changes in some of the markets, which we're going to look at in just a minute. Firstly, I'd just like to talk a little bit more on performance. There's a guy in Ireland who looks at 25 companies' performance reports every year and condenses it all. And I just take two examples of, and this is my story about performance and about how you all have millions of dollars sitting in your plants if you benchmark honestly against the best. So here, thermal efficiency. Kilns are different, I know. And so it's not apples and apples, it's apples, oranges. But we compare best in class, the green, worst in class, the red, and the average. There is, 20% variance. It's very big variance. Some of that is design, the model. Some of it is just pure performance. You look at the Indian plants, they're typically very, very performant. So this is thermal efficiency of the kiln. We'll look here at alternate fuels. Worst in class, basically almost no alternate fuels in many parts of the world. The average, round about 20%. The good, round about 30%. What is world class? World class is 100%. You go into a plant in Austria, it smells horrible, but it is 100% alternate fuels. And it's also in places like Malaysia, there's some very efficient, very performant alternate fuels. It's not going to be necessarily easy everywhere, but if you're focused on it, you invest in it as a business, I think you can be hugely successful. So my message is that how are you looking at operational excellence? And the model that I've been pushing for 20 years now, because when I first joined the cement industry, everybody lied to me. They say, we can't do this. We can't do this. Pure clinker. We must have pure clinker. We can't sell this. The clients don't want this. And I suddenly realized everybody was lying to me because they weren't being honest with themselves about what can be done. And the industry was trying to slow change, not allow standards to change. So we need to go faster. But I think the business model that we advise our clients is clear strategy and priorities. And if it doesn't make sense, don't do it. Go home, do something else. But if it does, you must have the resources. If you haven't got the resources, you will fail. And the resources are humans and dollars. If you don't have those, go home. Then execute well. We see we're in Asia here, and I think we see excellent execution in many parts. Certainly China, super efficiency. In Africa, we built the first Chinese plant back in 2003, and it was an absolute miracle compared to what we had before. And genuinely have a performance of culture, of openness, of innovation. And the other thing I'm very insistent on is the commercial and the industrial people must talk together, because otherwise they're in silos and everybody's blaming everybody else. So it's important to get it all happening. And I think with these models, you can put an awful lot of dollars on your bottom line. And obviously, everybody's talking AI, and AI goes back a long way. Dirk is somewhere around here, and we were discussing it last night. He was onto AI 25 years ago, quite rightly. It's changing very fast. We have these incredible technologies, the animal dog in the plant, which can do the work 24 hours a day. But it's really important. A plant has what? 1,500 sensors. How do you monitor all that? AI and whatever we want to call AI is a solution for that. But how do we do it? That bottom chart saying, well, that's how we understand. So we need to make it work for us, not against us. But I think this transformation of using data to optimize and to move much faster is very important. We've got other dynamics, which are problems such as standards and stuff where we're starting to move faster. So we did some research. We started doing this research about 4 years ago. Very simply, how much cement does it take to build a nation? And this helps strategy, understanding, should I invest in that market? So what we look at on this chart, and this is, first example, is how much cement is built in a nation. So if we look at South Korea, the green line, 38 tons. That is the total cement per current capita installed in that nation. Some's been demolished, and but it gives an indication of how much total cement per capita, per current capita, do you need to build a nation. And the other interesting thing is, you look, Japan, progressive. South Korea, faster. China, incredible growth. And China's up at that 35, wherever it is, mark. So that is a benchmark in Asia of what it takes to build a nation. 30, 40 tons per current capita. So you're looking for where do you go and invest your dollars successfully. And so we look. Oh, sorry, there's a mistake there because South Africa should read Vietnam. Sorry, error. But basically, so in Southeast Asia, we have 5, 9, 12 tons. So there's still huge need for cement in these markets. We go to my patch of Africa, Nigeria and Kenya, 2 tons installed. South Africa, 9. So what is that saying? We understand very well, Sonoma's here, Huaxin, China, West China, they're all very interested because look at that potential to go up to 30 tons per current capita, and the population is growing fast. So you're kind of fighting to chase it. So I think this helps to understand what the potential when you're going to invest in a market. And clearly, China, amazing run up, huge increase in capacity, consumption, and a very rapid decline. It is now 32% off its peak, and it's going to continue coming down because it's built. It's going to keep consuming, of course. So what are we seeing happening? we're seeing China has an incredible capacity to operate at scale. They go from nothing, unbelievable. Look at the evolution of railways, of roads, of vehicle exports, suddenly exploding. So when that engine turns, it is incredibly powerful. It built more than 2 billion tons of capacity in China in 20 years. Amazing. USA has 100 million tons of capacity. It has 100 kilns, and the oldest kiln operational in America is 100 years old. So, shocking. So, China built 24 times that in 20 years, more or less. So the power of China is incredible. And we look at the power availability in China, massive increases. I look at Africa a lot. This is the foreign direct investment. So, comparing the US, dark blue, with the Chinese. And so, I've been involved with Africa for a long, long time. And China has been constantly stepping up to new levels, ever higher, ever quicker, influencing enormously that environment. So I just looked at where are the Chinese cement companies investing. We don't see them in Europe. We don't see them in the US. We don't see them in South America. We see them in the stands, so Kazakhstan, Uzbekistan, lots of activity. This may not be 100% accurate. Each dot is designed to recognize that a company is in that country. Pricing terrible, capacity in some places problematic, but that's one move. So we see the Chinese quite aggressively going into the stands. We look at Southeast Asia, a little bit more nuanced. We haven't analyzed every country, but obviously there is Chinese presence in quite a number of countries. So, very good. That's fine. We know there's lots of potential. 10 tons can go to 30 or eventually 40 over a period of time. And that change is happening faster. The nations are being built faster. So, let's just go to Africa, which is kind of my spot, because I see my time is up, so don't worry, I'll try to wrap up fairly quickly. So, that's Lagos in Nigeria. This gives you some idea of the size of Africa when you compare what fits into it. The majors have turned off Africa. I think they're crazy. I think they should have built it, but they destroyed it instead, which is kind of silly. So, Huashin are coming in incredibly disciplined. They come in industrial optimization, commercial optimization, very smart market entry. West China is coming in very aggressively, but lacking the discipline, and as we'll see in a minute, their balance sheet is very stressed. And at the same time, we have the African entrepreneurs fighting for their territory, whether Bua, Dangote across the continent, 10 or 11 countries. On the East Coast, we have Indian entrepreneurs, we have African entrepreneurs. So it's quite an interesting dynamic. South Africa's different North Africa. So it's an interesting dynamic. So I think I've talked through that. We've also seen Sonoma acquiring some capacity in Africa, but at the same time they also build, so there's some conflicts there. Some of the African companies get a bit upset because, hey, you are a supplier or you are a competitor. So I think that's an ongoing discussion which has been around for a long time. So we looked at where are the Chinese plants in Africa, and if I showed you that from 15 or 20 years ago, there would be almost no dots at all. So this is an incredible evolution, and as you can see, it's dominated by Huashin and West China. There's some niches, Sonoma, um, Geelong in South Africa, and then there's a few other, like in DRC you see Zin, it's a mining company. So you see a number of players, but it's mainly dominated by the larger Chinese companies. And that is going to continue to evolve, and it will continue to become spread across the continent, I'm pretty sure. And that's not 100% complete. So we decided to look at, because obviously what's happening, it's in our interest as advisors, as investors, what's happening, who are going to be the winners in this game. And Huaxin, as we say, have come in. Their percentage of overseas revenue is going up quite nicely. They're also focusing strongly in China on, I think, on ready-mix and aggregates and sort of offsetting some of their cement decline. But overall, overseas revenue increasing steadily, now 35%. And their debt is increasing, but it's 2 times EBITDA, which is round about normal for a cement business, which is, let's call it, pushing investment hard for a period of time. West China, its overseas revenue was grown up to 75%, largely in Africa. It's got some in Uzbekistan, but it's not really profitable. But what we've been watching very closely is their debt levels. And it's almost at 4 times. And there's also a few businesses which are kind of West China, but they're not in the main part of West China, so they're linked to the owners of the company. So we think, what we think here will happen is that Conch will probably at some point acquire West China, because Conch used to want to be in Africa strongly. They had an office in Nairobi. So we're watching this quite closely. And if you look, in the last 6 months, West China have done 2 refinancing. They had a bond, $600 million bond coming due this year, June. They basically bought it back, but they had to reissue it at 10 times, at a coupon of 10%, so double their investment cost. And they're trying to sell businesses in China to Conch. They've sold some. We think they're selling some more. So we may see some change. And what we've also seen here, if we look at Ethiopia, they went from 1.3 million tons of sales to 4 million tons of sales, but the sales, the price collapsed. They went in too aggressively, and so the price collapsed. I think they would have been better to think about keeping the price high and not going quite so aggressively in the market. They did the same thing in Great Lakes, the price a bit less, but the profitability has come down a lot. So we're watching this closely and seeing the implications for the industry in Africa. I just got 2 slides to wrap up. So we could look at many other markets. I think there's a fascinating market, which is Nigeria, a market I know very well. Huaxin have come in, paying $1 billion US to buy Lafarge, Holcim, Nigeria, let's call it. And you can see that the EBITDA margins are stunning, 50%. And this is with kiln utilization at less than 50%. So there's a great deal of discipline in that market. What's interesting, though, Dangote keeps building. His refinery is working, huge cash flow, and he's just committed $1 billion to Sonoma, I think, for new plants across Africa. Bua, again, announcing. And they do 3 million tons, EPC, with power, for $240 million in Nigeria. That's an incredible deal. Huaxin, they only just bought that company. They're already planning 3 new kilns. So I think it's going to be very interesting. There's one new entrant, there's another new entrant who's not on that slide coming in. So I think it's very interesting. And we saw Arno putting a slide of some of the dynamics of global clinker and cement trade. Most of West Africa has no limestone, or very little limestone. So a lot of it's clinker. But what's happening is Nigeria is aggressively exporting. Senegal is going to start to export. Congo is exporting. So the big blue arrow at the top from Turkey, Algeria, Egypt, there's not much of that going to come. And at the bottom, where it's coming from Saudi, from Vietnam, etc., that's also not. So the dynamics of trade are going to change, we think. And it will be much more a locally driven market from all that excess capacity in Senegal, Nigeria, Congo, and ultimately Angola. So I think we're in this situation with what we describe as musical chairs. And again, Arno had it there. Europe is an island defending itself with a big CBAM, probably going to remain very profitable. US, very profitable, but will it be so profitable with everybody wanting to invest, everybody wanting to buy, how that's going to happen? And then China continuing to slow its consumption, it's normal, but using the huge human and financial resources to go into those markets where they're running at single digits tons installed of cement, and they need to go to 10 to 20 to 30. So I'll leave it there because I know my time is up, and thank you very much, everybody.